This week, global markets are rattled by two major shocks: a sudden, unexpected sell-off in government bonds, which sent yields soaring and left investors scrambling to reassess their strategies. At the same time, a dramatic plunge in cryptocurrency prices has added to the sense of unease, with Bitcoin and other digital assets tumbling in value almost overnight. Investors everywhere are shifting from risk-taking to caution, creating a ripple effect that stretches from the bustling trading floors of Tokyo to the heart of Wall Street in New York. The mood has changed almost instantly as uncertainty takes hold. The turmoil began with Japanese government bonds, where a sharp move in yields caught even seasoned traders off guard, sparking concerns about the stability of global debt markets. This was quickly amplified by a sharp drop in Bitcoin, as panic selling spread across crypto exchanges, wiping out billions in market value and fueling fears of broader contagion. These events have made both professional traders and everyday investors pause, turning the global marketplace into a bumpy, unpredictable road where every headline can trigger a new wave of volatility. The big question now is whether this is just a temporary blip, a momentary panic that will soon pass, or the start of a deeper, more lasting shift in the financial landscape that could reshape markets for months or even years to come. Even distant events, like a bond sell-off in Japan or a crypto crash on the other side of the world, can have a direct impact on your mortgage rate, your retirement savings, or the returns on your investment portfolio. The effects are often felt in ways most people don't expect. The interconnectedness of bonds, cryptocurrencies, stocks, and currencies means no event happens in isolation. A shock in one corner of the market can quickly ripple across the globe, affecting everything from interest rates to commodity prices. In the next sections, we'll break down what triggered the bond sell-off and why it matters for investors everywhere. We'll explain the crucial link between interest rates and bond prices, and how changes in central bank policy can send shockwaves through the entire financial system. We'll also explore how these forces are shaking up markets worldwide, from Asia to Europe to the Americas, and what it means for investors of all sizes. We'll look at the impact on stocks, currencies, and how investors are rethinking their strategies in real time. Plus, we'll examine what's happening with commodities like gold and oil, which often act as safe havens or bellwethers during times of market stress. Our goal is to bring clarity to this moment of confusion, helping you understand what's really moving the markets and what you can do to navigate the uncertainty ahead. The first shock to global markets came from Japan, where Bank of Japan Governor Kazuo Ueda signaled a possible interest rate hike, a move that caught many investors off guard. For decades, Japan has been known for its ultra-low interest rates, a policy that shaped global investment strategies and kept borrowing costs low around the world. For years, Japan's rock-bottom rates pushed investors to seek better returns abroad, fueling investments in everything from U.S. Treasuries to emerging market bonds. But now, with the Bank of Japan hinting at a shift, that era may be coming to an end. Investors are suddenly rethinking their strategies, wondering if it's time to bring their money back home to Japan.
The reaction was swift and dramatic. Investors dumped Japanese government bonds, sending yields soaring to heights not seen in nearly 2 decades. The sudden sell-off sent shockwaves through trading floors, as market participants scrambled to adjust to the new reality. The 10-year JGB yield hit 1.88%, a level not seen since 2011, while the 30-year yield surged to a record high. These numbers signaled a dramatic shift in Japan's financial landscape, and investors everywhere took notice.
Why does this matter globally? If Japanese rates rise, investors may pull money back to Japan, raising borrowing costs worldwide. This could impact everything from mortgage rates in the US to government borrowing in Europe, as global capital flows shift in response to Japan's new direction.
The panic cooled after a strong bond auction, which reassured some investors. But the message was clear: the Bank of Japan is no longer a source of endless cheap money, and the days of ultra-loose policy may be numbered.
This shift has set the stage for heightened volatility in bond markets everywhere, as traders and investors brace for more surprises from central banks. Investors are bracing for ripple effects as global capital flows adjust, and uncertainty becomes the new normal in financial markets. The world is watching Japan's next move, knowing it could shape the future of global finance for years to come. To understand the market's reaction, you need to know how bonds and interest rates interact. A bond is essentially a loan to the government, paying fixed interest over time.
When interest rates rise, new bonds pay more, making old bonds less valuable. So their prices drop and yields rise. If rates fall, old bonds with higher payments become more valuable, so their prices rise.
This seesaw effect is why central bank policy changes can send bond prices swinging. In Japan, the expectation of higher rates triggered a sell-off in lower-yielding bonds.
Meanwhile, in the US, weak economic data has investors betting on rate cuts, making existing bonds more attractive.
Understanding this simple relationship is key to making sense of the current bond market chaos. It's the engine behind the volatility we're seeing now. The bond market's moves are never random. They're all about expectations. Japan's bond shock quickly rippled across the globe, landing hard in the US and pushing Treasury yields sharply higher. It was a textbook example of how interconnected today's financial markets have become, where a single event in Asia can send shockwaves through Wall Street in a matter of hours.
But the US story is more complex than just reacting to global tremors. Underneath the surface, America's economy is sending mixed signals that are making it even harder for investors and policymakers to chart a clear path forward. On one hand, manufacturing is slumping, hinting at a possible slowdown and raising concerns about future growth. Yet, on the other hand, American consumers are still spending big, keeping the service sector humming and defying expectations of a downturn. This split leaves the Federal Reserve with a tough choice. Should they cut rates to boost growth and support struggling industries, or hold steady to keep inflation in check? The stakes are high, and every decision is being scrutinized by markets and Main Street alike.
Markets are betting on a rate cut, which pulled Treasury yields back down after their initial spike. Investors are watching every Fed statement, searching for clues about what comes next.
The 10-year yield settled near 4.09% as investors weigh global pressures against domestic weakness. Every move in the yield reflects a tug-of-war between fear of recession and hope for a soft landing.
The Fed's next move is uncertain, and that's keeping investors on edge. Volatility is the new normal, and even seasoned traders are finding it hard to predict what's coming. The US bond market is caught between rising global yields and a possible economic slowdown at home, creating a challenging environment for everyone from pension funds to individual savers.
For now, the expectation of a Fed rate cut is winning out, giving markets a temporary sense of relief. But uncertainty still looms large.
This ongoing tug-of-war between optimism and caution is what makes today's market so unpredictable, with fortunes shifting in real time. Investors are navigating a landscape shaped by both global and local forces, where every headline can move markets and every decision counts more than ever.
While bonds were in turmoil, Bitcoin suffered a sudden 5% drop, erasing billions in value in hours.
The crypto market's volatility rattled investors, reminding everyone how quickly fortunes can change.
Longtime crypto holders are used to wild swings, but this plunge pushed Bitcoin far from its recent highs.
A modest rebound followed, but confidence remains shaky.
The crypto sell-off is adding to the broader sense of market instability.
When major assets like Bitcoin tumble, it chills risk appetite everywhere. The turmoil in digital currencies is fueling global uncertainty.
With bond and crypto markets in flux, global stock markets are moving cautiously. US indices fell, then steadied as investors paused to digest the news. In Asia, Japan's Nikkei stabilized after a sharp drop, while South Korea's Kospi jumped and China's CSI 300 fell.
The MSCI Asia-Pacific Index rose slightly, showing that some markets are finding reasons for optimism. Investors are picking their spots, not selling everything.
Local conditions and company news are driving regional differences.
The result is a market on a tightrope, balancing the risks of a bond sell-off, hopes for a US rate cut, and crypto volatility. Investors are defensive, waiting for clearer signals. The global market is a patchwork of caution and opportunity.
Bond market turmoil has shaken up currency markets, with the yen strengthening as Japan eyes higher rates. Higher rates make the yen more attractive, holding firm at 155.64 per dollar.
Meanwhile, the US dollar is weakening as expectations of a Fed rate cut grow. The euro briefly rose above 1.165, taking advantage of the dollar's slide.
December is historically a weak month for the dollar, and this year is no exception.
These shifts have real-world effects. Stronger yen could hurt Japanese exports, while a weaker dollar may boost U.S. exports. For travelers, exchange rates are shifting the cost of trips and imported goods.
Investors are positioning for more currency moves as central banks adjust policies.
The forex market is reflecting the new economic reality. Currency swings are amplifying the uncertainty.
In times of turmoil, investors flock to gold, which is holding above $4,200 an ounce as a safe haven.
Gold's strength signals deep investor anxiety and a search for stability. Oil, meanwhile, is rising due to supply fears after attacks on Russian energy infrastructure.
Brent crude is steady at $63.17 a barrel, raising concerns about inflation and economic growth.
Higher oil prices act like a tax on the global economy, complicating central banks' efforts to control inflation. Gold and oil are telling two stories, one of financial fear, one of physical supply risk. Both have big implications for consumers and policymakers. The commodities market is a key barometer of global stress.
What does all this mean for you? Rising global yields could make borrowing more expensive, but a Fed rate cut might bring relief.
The week's turmoil is a lesson in diversification. Don't put all your eggs in one basket.
Currency swings affect prices of everyday goods, from electronics to wine, and can boost U.S. exporters.
The best move for most investors is to stay calm, review your plan, and focus on long-term goals.
History shows that patient, disciplined investors weather market storms best.
This shakeup is a test of that discipline. The financial world is unpredictable, but smart strategies endure. Stay informed, stay diversified, and don't let short-term noise derail your future.